de-dollarization narrative to digital currency. So, over the next decade, do you see a genuine structural change coming in, or it is just cyclical noise which we should just ignore and move on?
I think we cannot do anything about it because which currency you will trust?
What you see in India, don't you see it moving from the savings culture to the investing culture? I'm sure the SIP book every month is growing at a stupendously fabulous rate.
So SIP money, I call it blind money.
Welcome to Inside a Mind of an Investor podcast, where here with me, Anjali, we have Mr. Bhuvan Gupta, who will be sharing with us his experience over various cycles, his mistakes, and of course, his evolution. So, markets may seem to be very shining on the outside, but we know underneath lies a lot of chaos. Geopolitics, currency debates, asset bubbles, and there is a lot of noise. So, let's go over to Bhuvan and try to know from him his experience as a seasoned investor.
Yes, always. Thank you. Thank you, Anjali.
So, my first question to you, Bhuvan, is that as Howard Marks says, that experience is what you got when you didn't get what you wanted, right? So, I'm sure when you must have started your investment journey, you must have had your beliefs, which experience later forced you to change.
Absolutely, Anjali. So what happens is, first of all, the experience is nothing but the mistake which we named as an experience if we learn from it. Now, whether it is your journey or my journey, we all have gone wrong in stocks, or probably we have a lot of these things where we have gone wrong. So I think my experience is that price, the Bhav Bhagwan Che, is what is the absolutely a misnomer. And in some of these stocks, when I have not followed the checklist or when I was not a fund manager, I have gone wrong. So we have borrowed this famous thing called the value investing is a three-legged stool from Chuck Akre, who is the famous value investor. The value investing is a three-legged stool. The first leg is quality.
Okay.
Then comes the growth, and then come the valuation. Now, if you are right on quality, even if you have gone wrong on the price or the growth, you may not lose money. If you look at Apple, Google, or Amazon, they have always been highly valued on the traditional parameters. But at any valuation in the last 5 or 10 years, you have invested in them, you made money. So the one thing which I learned is quality comes first from my own experience.
So, from Bhav Bhagwan Che, we are moving to quality first.
Quality is everything.
That's interesting.
Quality is gold.
Okay, gold. Yes, everything is glittering right now.
Yes.
For sure. As we know, Bhuvan, that US is sitting on a $38 trillion loan book, and it's ticking and just growing by every second. So there is this growing debate around the long-term role of US dollar from de-dollarization narrative to digital currency. So, over the next decade, do you see a genuine structural change coming in, or it is just cyclical noise which we should just ignore and move on?
So Anjali, that change is already started, and that is why you're seeing a gold play. And it all started with the Russia invasion or the Russia being
US
attacked
blocking the.
I'm not a geopolitical expert, but I strongly feel that yes, this is happening. But at the same time, I think we cannot do anything about it because which currency you will trust. So still, the dollar is the way to go. And yes, it may happen that some other country will come up, and even I will be watchful for the development. Let's see.
All right. Adding on to the previous question, with geopolitics and current volatility, is diversification across different geographies and currencies optional, or is it the need of the hour? What do you feel about it?
So see, when we talk about diversification, I believe as an Asian, we are over diversified.
Okay.
Now,
can you zoom in a little more on that?
Sure. So any diversification is of no use if you do not understand what we are doing. So look at the billionaire in the world. All of them are into 1 to 5 companies.
That's it?
Yes, if you look at look at Jeff Bezos, one company.
Absolutely, Amazon.
Look at Bill Gates. In fact, he lost money when
Microsoft,
he
yes.
lost money when he diversified. So he is the second largest shareholder of Microsoft, and he's about 150 billion odd or 200 billion odd from the Microsoft. Look at Elon Musk, three companies probably,
Correct.
and the maximum money has come from Tesla to start with.
True. The others are more of a dream
Right.
project right now.
Absolutely. So I believe that diversification, and even these mutual fund schemes, if you look at, you'll find half of them have the same holdings. So please understand, if you understand a particular business or the investment, that concentration itself is diversification. Because for me, Amazon is 50 businesses. Like Berkshire Hathaway has roughly 50 plus businesses. So I think diversification is fine. But are we able to manage them? So it is better to be in around the circle of your competence and have only 4 or 5 companies. A very good example I'll give you, Nick Sleeper. When he wrapped up the fund, he only had 3 stocks.
That's it.
Yes, and he started going back to the racing track, road to Buffett, and he only had 3 companies. 2 I remember. I think 3 of them is Berkshire Hathaway, Amazon, and Costco. So the devil lies in detail. The more you go inside the detail, you probably will have fewer assets.
That's an interesting insight, Bhuvan. Thank you for that. Moving on. What do you see in India? Don't you see it moving from the savings culture to the investing culture? I'm sure the SIP book every month is growing at a stupendously fabulous rate. What do you think? Is it long term financialization, or as investors, we should be aware of the excesses that's just getting pumped into the market?
So SIP money, I call it blind money. Now, obviously, we will be moving from SIP to ETFs also. The challenge here is to understand that it is not the end of the bull run, it is the starting of the bull run
For India as well?
for India. In fact, for India.
Okay.
The currency of India has moved what an emerging market currency would have moved. But now time for India is to behave like as China did. So if you look at 20 years for China, China's currency is not depreciated. Now people are always driven by past. But to answer your question is that lot of opportunities also being created in India, like Urban Company. It came from nowhere. Zomato, Swiggy, Blink. They are some of the businesses which are only thriving in India because there is no parallel from the American world or from the West. So there are a lot of opportunities coming in. In fact, after the GST reform, I believe a lot of these business people have understood that it is better to list the company and raise money in the equity, because India has a tremendous possibility, because people are learned, people are hardworking,
The demography
is amazing, and we
supports
are
as
young,
well.
and we are young, correct.
True.
And then we have all seasons. So we have, in fact, we are so rich that we can even sell our water. The agriculture, like there is a usual saying that dharti mein hi sona hai. So I think India has a huge runway to grow, and we all have fantastic time ahead.
Fantastic. So you think that this SIP book is justified right now? Adding on to that, when do you think a great company stops being a great investment?
Yeah.
As Charlie Munger has warned, that even the best of business can be a terrible investment idea. Do you have anything to share on this?
Sure. So when you invest in a business to start with, you invest in the book value. But when you invest in a business in the share market, you're actually investing in the stock at market price. So if I tell you Apple's book value is 50 billion, but Apple's market cap is 3 trillion.
Correct.
So look at the kind of multiple you are paying.
Valuation.
Now it has to move in the same growth rate for you to make money at the market price or market value.
At which you have entered.
Absolutely. But the real investment, obviously you should not get the Apple at the book value. So what happens here is, if you remember Wipro, I think in the last 20, 25 years ago, whoever bought Wipro, it took probably 30 years for them to break even. Similarly in Japan, if somebody would have bought, let's say in the 90s, he would have taken 30 plus years to break even.
Correct. The market didn't move.
Right.
For
So
Japan.
when I told you that valuation will be taken care of if you have the quality intact, but then I meant 10 stocks, because one of them or two of them you may go wrong, but rest of them will cover themselves. Because now in the era of memes, sometimes it happens that a stock is very, very highly valued. That price you should not pay.
Just connecting back on this, so do you think risk can be controlled at the portfolio level, or we should focus on specific stocks within the portfolio as well? What is a better metric to ensure that it's not getting too risky?
So first of all, investment management or the portfolio management is all about risk management. You can never manage returns. And in fact, God said that only we can do only our deeds. The fruits of actions are not in our hands.
Not in our hands. Yes.
So at the stock level, itself is a portfolio of projects. So if you buy Amazon, you have Whole Foods, you have Amazon ad business, you have Amazon retail business, and then you have AWS, etc., etc. So when you are buying a company, you should, if people like me will avoid debt, we look at the hunger and the growth. So every, and I think very good thing I'll tell you, that सागर समाया बूंद में, सागर समाया बूंद में जाने विरला कोई, बूंद समाई सागर में जाने सब कोई. So micro and macro for me are same. So I would like to have the risk mitigation at the stock level with a checklist of mine.
Okay.
And then I would like to have a portfolio constructed so that not everything is into one field. And that is how I would like to manage. So I think stock level and the portfolio, both level risk management is must.
So you would look at your portfolio and you would calculate the P of your portfolio as a whole.
Yes.
That's interesting.
Yeah. So in fact, in the the investor conference, we told that look at our product as one stock. That's how people should be.
Cumulative of
Correct.
its holdings within.
In fact, each and every stock is some of the projects. It is nothing but the average of the weighted average of all those cash flows and the return on capital employed and the growth. So at every level, the risk mitigation is important. So I have a very famous saying. We don't have a debt in the portfolio companies. We don't have a debt in the portfolio. We don't have a debt in the business. We don't have the debt in our personal life. And that is how you also tackle this geopolitical tension.
That's perfect and very clean, Bhuvan.
Yes. And in fact, one more thing to add here. I would like to make my life work around what will happen, not when it will happen. So let's say if I don't make you money in this year, be ready, be prepared, have a lot of humility, because market is the only king. So I am going and telling the world that a 20% downside is possible at any given point of time. So I think if we have a little longer horizon, we're fine.
On humility, don't you think that as the price rises, humility usually falls? Bull markets don't just test portfolios, but they test discipline. So during euphoric bull markets, how do you protect your own decision making and remove all the behavioral biases?
So market has two cycles, fear and greed. And that will never change.
Correct.
Like behaviors. It's all more about behavior. Yes, success are very lousy teachers. But I think the checklist makes the work easier. So if we have a checklist, we rigorously follow it. It out of, let's say, 70 criteria, if 60 plus do not meet, we will stay in cash or stay in the, let's say, commute like gold. So we're very clear with it. Yes, today we know we are successful, and it is very important to stay humble. And actually, one more thing is very important, which I learned during the time. We are not into asset management business. We're into client liability management business.
Wow, that's indeed a very interesting perspective for sure. Bhuvan, I would like the viewers to really rewind this and listen this back again, because it's an amazing word packed with wisdom, Bhuvan.
I think that comes for the cycles, and when you face people the tough time. And I think one thing is very clear to me, that I am not the one who has made you money. I'm very clear about it.
That's your humility, Bhuvan.
That's the fact.
Okay, from that, moving on to a very critical question, which would make audience question your role when I'm talking about passive investing. Passive investing has been probably the greatest disruption in asset management, but markets still move because someone somewhere is making an active decision. Having said that, in today's highly efficient markets, can active funds still beat the S&P 500 index over a full cycle run?
That you should tell. So yes, active investment is still alive. It will always be there because the cycle of greed and fear. On the contrary, the passive investments are not passive.
Are not passive.
Yes, because every 3 months they need to change themselves as per the index composition. So the decisions are must. It is just that the system takes the decision, and we can brand it like it is going to mimic the benchmark, and because of that you're paying low fee because the human aspects is not there. So in the future, two types of business will survive. One is the boutique niche like ours, and one is the tech faceless businesses like BlackRock, or you could talk about Vanguard. These are the companies, because even at $5 million, since they are mimicking the benchmark, they won't come and meet you.
If I may ask, which one of the two do you think will outrun the other?
I have no idea, and I believe both of them are very, very big. So I'm no authority.
I thought you would take this opportunity to sell yourself harder on this.
I don't believe in selling. I believe in helping you to buy. And that's very clear to me, because we believe in partnership. So we work on performance fees. So it's very clear to us that why should I sell it to you when I'm going to benefit, when you're going to benefit. So we are together into this. So it is no I versus you. It's us.
That's beautiful, Bhuvan.
Thank you.
Moving on to this, just so many IPOs. There's a buzz of IPO in the markets. I probably feel that IPOs is something where the stories are the loudest and the number are the quietest, the data available on hand. How do you evaluate IPOs in the US? And would you apply the same framework to India as well?
So see, in IPO, the only problem is, let's say they have companies like Zomato, but they also have companies like Wirecard, where everything is down the drain. But having said that, the only challenge in the IPOs is finding a needle in a haystack. And I know I am not a genius. And I learned from Buffett that let's avoid finding one needle in the haystack. So it is better to buy these IPO companies when the P investor or the VC's lock-in gets over. So let's say, for example, I'll give you
So that's 6 months after listing?
Of listing. So let's say urban company. Just for example's sake, the stock is going down. Nobody's talking about it. But are you a user of urban company?
Absolutely.
I am as
Yes.
well. Great service.
Absolutely.
And I think they're getting free publicity. But all I'm saying is that this company doesn't have a parallel. Now, what is the right valuation? Probably when the lock-in periods get over. Now, I may be wrong, but Zomato has a similar story. And probably other companies also have a similar stories. In the olden days, when HDFC or Titan came public, this was a different time. Today, we are into information era. Meme stocks are common. So I believe IPOs are a great place to see new businesses, but invest when nobody is talking about it. Nykaa is a perfect example. Today, Nykaa is down the drain. Nobody's talking about it.
True.
So one should look at these kind of stocks or the companies to invest.
So you think it should not be at the IPO price, but you should just let the markets find the right balance for you to enter in those companies.
Just one example. So IPO is
Sure.
nothing but equivalent to the new property launch.
Okay.
Now you tell me, if you are buying one house, will you get better pricing, or if you'll buy 10 houses, you'll get a better pricing,
Of course, more the better.
right? So capitalism, if you have more money, people will come to you. Lenskart came to Adia and got $240 million. Why you will not get the Lenskart at that price? So what will happen? You will get a lousy prices for maybe a good company or great companies. And that is why for 3 to 5 years you will not make money. And you will lose patience as a retail investor and you will exit. So IPOs are comparable to the real estate. The day you have $100 million and you are into the institutional investor zone, probably you should look at IPO because you might get a favorable price or maybe you can get a pre-IPO offer. So till that time, I think IPO should be avoided. Yes, I would like to look at these companies where nobody is promoting these to me because then I can easily find a needle in a small haystack. But here in the IPO or in the pre-placement offer of the property, I am looking at a needle in a haystack. The olden days, things were different. Still, we have good companies coming at the right valuation in the IPO, but they are very, very few. So it is better to avoid the
So
IPO.
it is the valuation which really stops you from delving deeper into the IPO market?
Obviously, you need to understand who are invested in this IPO. So let's say I am growing my daughter and she is now 25 or 24 and I'm marrying her. Even whatever qualification she has, whatever she's doing or not, I will try to make sure that I get the best prince for her. Now, this is why people will lose money in the IPO or they should avoid the IPO. So what happens that VC enters in the company 3 or 5 years ago or the private equity, they want to squeeze all the returns or the money.
Correct. So basically, I think we are not investing in the company. We are just paying for the VCs to exit, which may not be a fair valuation.
Absolutely. So insider knows everything about the company. They end up selling it to the retail investor who knows nothing about the company. And look at it. We all have the brokerage account. We will be pushed that this IPO is coming. And what we will do? We know that we will not get the full allocation and we end up just pressing a button.
Correct.
So it's like basically handing over the money to people legally, to people who are sure going to lose you money. And you may go lucky in 1 or 2 companies and that should not become the norm.
So you are far, far away from the IPO buzz.
Absolutely. Right now, I am away from the IPO buzz.
Perfect. Thank you. Thank you for your insight on that. Bhuvan, I would like to ask you personally, what is your take on Chinese investment at the moment?
So I have earlier also said China is a great economy because they have the ability to produce good quality product. In fact, I ended up buying a Chinese car with all opposition from my family, but best product, best quality, best pricing. But I don't invest in China.
Any particular reasons for the same?
Anjali, the very simple reason is there is a investor called Waters Calls who was the classmates of Buffett with Ben Graham. And you tell me in communism what is the whole agenda? The agenda is different. So in the communism or in the Communist Party, the transparency is the key.
Yeah, they fail there.
So a lot of people have made money last year in China.
Me too.
Great.
Yes.
It's a strategic or let's say tactical investment, you can make it. But in the market where the index has not performed, do you think you and I have an advantage? So I believe I would like to invest in a democracy and I have many democracy to look at. I just have to buy 10 good companies, and in that 10 also I have to be correct only 3 or 4 times.
Perfect.
Then why do I want to go to China and then sell it and then buy again when they are available at the cigar butt pricing, which was the case last year? So I would like to avoid China.
So you think there are many other demographics which offer more lucrative investment opportunity? Then why invest in a communist country?
So with due respects, it is not my circle of competence. Lilu has made money in China for people. He is from China. So he has a natural advantage and biasness towards China. Like a lot of us have the biasness for India.
Of course.
And they still have made money in India. It is not that they have not made money. Even the market has not done well last year. So I think I know less about China right now. And plus, they have this complex structure of variable interest entity where we don't own the actual company in the lot of online businesses, and then you end up owning the company or the which owns the option in the Chinese market, which I wrote in my annual letter. So I think I will be avoiding it, and my seniors have done so. I have learned from my own mistake, but my seniors have avoided China. So I think there is no way I would like to experiment to this today. Unless I get somebody like you who's an expert in China.
I'm not an expert. Let's call it I was just lucky. I appreciate your fairness and authenticity on this, Bhuvan.
Thank you.
Let's move on to the rapid fire section. The rules of the games, we have to keep it concise, no elaborate explanations. All right, so you're ready for this?
Yes.
Sip a cup. Sip some coffee, you will need it.
Yeah, fire.
All right. Luckiest generation financially.
Gen Z, our children.
All right. Direct equity or equity mutual funds?
For me, direct equity.
Biggest mistake retail investors are making right now?
Chasing the price.
Bhav Bhagwan che. Okay. Overrated metric investors are obsessed over?
Price to earning.
P. One asset class people misunderstand the most?
Equities, and equities.
Okay. Gold or crypto?
For me, gold.
Gold or UAE properties?
No comment.
Concentration or diversification?
Concentration, always.
Okay. Best advice you have received about money?
Freedom.
Lovely. So, Bhuvan, if I may ask, which investor has had the maximum influence on your investing style? Would you elaborate a little more on that?
So Anjali, it's a open secret, or it's not no secret. Warren Buffett, my office and my table. In fact, I think soon I should have a logo of him on my clothes. So Buffett, and Buffett.
He's your investment guru.
He is my everything because the way the Asian society is structured. My father never asked me how much money you have made. All he wants to know that whether I ate well or I slept well or not.
True.
So Buffett is one I admire him because he has taught the world that create the maximum and live in the minimum. Now the same goes with my spiritual philosophy also. So I'm too admirer of Buffett because that goes well with my culture at home or Indian culture, and also in terms of making a lot of wealth but not flaunting it. So I'm in the journey.
Frugality.
Yes,
At
frugality,
the base of all.
frugality. Yeah, frugality, and frugality. And in fact, I would like to invite you, join me on 1st May to Omaha. Obviously, you might not see Buffett on the stage because he's now taken a back seat.
Correct.
But the culture goes on. And I think Buffett is in the soul of all the value investor today.
So you have been going to Omaha over so many years?
So I've been going since the COVID period. I was there for now like 4 years plus, and my family goes with me. My little Charlie and Warren, my daughters also go with me. And this time, in fact, I'm doing an event myself. So it's like a pilgrimage for me now.
That's amazing.
And you should come and join me because everybody who says that stock market is very risky and it is non-physical, when they will see 40,000 plus people over there, they'll see the exhibition of the holding or the subsidiary companies. They will realize that this is the great place to create wealth peacefully.
So the philosophy of Warren Buffett still proliferates in the entire Omaha.
In fact, every other person is his shareholder. And when you will be there, they will meet you. A barber met me last time. And he started telling me that how he got featured in newspaper in the 1990s when he was the early investor of Buffett.
Wow, that's interesting, Bhuvan.
Yeah. And I think I would like to do the same.
All
So
right.
the game is on, the work is in progress. And I think if the whole city is your investor, what else do you want?
Bhuvan, resonating with today's podcast topic, which is inside the mind of the investor, for the benefit of the larger audience, which books would you recommend them to read so that they become better at the game?
So first of all, it's very important to know who you are. So I have been telling this again and again. Srimad Bhagavad Gita for self. One Upon Wall Street for understanding how simple is the investing, an almanac of Charlie Munger to
Okay.
understand how the life has to be lived. These three books are a great combination for anybody who would like to start investing and yet have a lot of time for him outside of the trading window.
I'm sure, and these books can be reread so many times because each time you pick it up, you learn something new, which you could have missed the previous time.
So, Anjali, I always say that it is not that you have to go through the book has to go through you. They are the timeless wisdoms, and it requires many read.
Very well said,
Yeah,
Bhuvan.
yeah.
So, thank you, Bhuvan, for a very thoughtful and grounded conversation that we've had. I'm sure there are nuggets of knowledge which audience will be able to take home and become a better investor. So, for sure, this podcast was not about any tips or predictions.
Never.
It was about how to think clearly when there is just too much of noise all around. So, folks, if you found this useful, please do share with someone who wants to become better at the game of investing. Thank you very much.
Thank you, Anjali. It was a pleasure talking to you.